We once had a founder that was working with us through the studio, and we realized that they were actually cooking their books. We brought it to light because they had a hard time paying our invoices. We had also made an investment in them, and finally I reached out to the lead investor on the cap table, and I called them up and I said, hey, are you aware of what's going on with company? We're really worried about them. And the lead investor said, what do you mean? They're doing great. We just saw their financials. From our perspective, they're one of our strongest portfolio companies right now. Like, really what was happening was the founder was effectively embezzling that cash.
Welcome to the Inside the Fund podcast, where we go on the other side of the table and learn about capital raising from VCs. I'm Helena Fogarty. I'm a fundraising expert who helps startups raise their seed and Series A rounds. And today, I'm speaking with Jess Schram, partner and director of investments and incubations at Remedy Product Studio. Remedy couples strategic capital with technical resources, investing in software businesses that are fundraising to accelerate the velocity of their product and engineering teams. They are a generalist corporate VC, investing off the balance sheet into early-stage companies across health and wellness, fintech, commerce enablement, and data tools / B2B SaaS. Like any VC fund, Remedy writes cash checks, typically up to $200,000, but the investments are deployed monthly over the project period as a pseudo form of vesting, while the studio provides full-time engineering and product resources. Remedy's portfolio companies have raised over $1 billion from top-tier firms with notable exits including ClassPass, Block6 Analytics, and Health Reveal. Jess brings a fascinating perspective, having worked in venture capital at multiple firms. She's angel invested, she's operated a seed-stage startup, and most recently started her own advisory business to help prepare founders for fundraising. Jess, thanks so much for coming in today.
Of course. Thanks for having me.
Yeah, so I would love to go into kind of your origin story.
Sure.
How did you get into this?
Yeah, I love telling this story because I was not a very traditional business school undergrad student. I didn't even know what venture capital was until I was probably 27 years old, 5 years or 4 years out of undergrad. And I was actually working in consulting. I was working on the digital transformation team at a company called Edelman, which many people might historically know as actually one of the largest PR agencies. I'd never done PR at Edelman. I was always a digital project manager and then transitioned onto their digital transformation consulting practice. And my decision to move into venture was really a pretty intentional self-reflection about what I liked in my role as a consultant and what I wanted to optimize for. And what I mean by that is, as a consultant, you need to be able to get really smart really fast on a new industry, smart enough to be able to at least ask the right questions and know who to reach out to become an expert in a really short period of time. Because you as a consultant, again, 26, 27-year-old, are advising C-suite executives in industries you might not have even worked in before. So that is a really transferable skill into venture, especially generalist VC, because you're often thrown into a new industry and need to get very smart very quickly. But what I did not like about being a consultant was this idea of being arbitrarily assigned an industry that you might not give a shit about. Sorry if we can't curse on here. I will be doing that. So I really didn't like that arbitrary assignment. I didn't like working on Samsung Mobile and being an Apple user. There's no amount of marketing that's going to make me use Samsung with the inherent network effects of Apple. I was working on Heineken. I don't drink beer. There's no amount of marketing or advertising that's going to make me a beer drinker. Things like that felt extremely inauthentic. And so my manager actually approached me, and I was really fortunate to have an incredible mentor actually throughout my lifetime at Edelman. I was there for quite a bit of time. And he said to me after a one-on-one, have you ever thought about a career in venture capital? And I said, no, I don't even know what that is.
Yeah.
And so he spent some time explaining it to me, introduced me to a few of his buddies who were in venture. And I had this kind of aha moment where I realized that venture allows you to be able to effectively choose the businesses and industries you're really passionate about. Because there's one thing I know about myself. It's that when I'm interested in something, I excel at it. Like, I can go deep in a rabbit hole. You don't want to cross me in an area that I know really well. I pride myself on that, always have. And if I'm able to choose companies that I'm passionate about and I want to double down on and invest my time, literal money and energy into, I know I'd be great at my career. And having those transferable skills of being a consultant,
Mhm.
getting to know different areas of a business and identifying problems and solutions and coming up with strategies and being the smartest person in the room effectively when you haven't even worked in that industry is sort of what venture is all about. If we're being honest, every generalist VC is somewhat of a poser. Most VCs have very limited industry experience in one or two of their past lives. Mine happens to be healthcare. Spent a ton of time in healthcare as a consultant, and my first VC fund was a digital health fund specifically. But now that I'm a generalist, I'm just pretty honest with myself about what I know and don't know. And I think those are the smartest investors because if you're honest with yourself about what you don't know, you're way more savvy about finding the right answers instead of trying to be a hero and making the wrong calls.
Yeah. So can you take us through how you moved from Edelman to Remedy?
Yeah, so I went to business school. For me, I thought that was the only way to transition from this kind of not relevant career path into venture. I knew that I needed to fill in some skills gaps because, like I said, I wasn't a business school undergrad. So I went to Columbia Business School and then did all the venture capital coursework. I took it extremely seriously. It was sort of my beeline career strategy. A lot of people that go to business school, VC sort of maybe like a backup because you forego all of the internship opportunities in the middle of the year and the very rigid consulting, banking, big tech tracks that are kind of presented to you on a silver platter in
Yeah.
business school. These companies come on campus, they hire interns, they unless you're basically picking your nose, you get the return offer. Like there's very formal processes around this, at least pre 2022. I know the job market has really changed since then where it's a lot harder to get those jobs, but when I was in business school and, years before me, it was pretty straightforward. Like get into a good program, you're
Mhm.
basically guaranteed to get a job.
Mhm.
Venture is not like that. There is no on-campus track. It's very on-time hire, and so if you're going into B school with the intention of trying to get into VC, you gotta hustle. At Columbia, they actually call it the entrepreneurial track. It's either being a founder or being in venture. And so I applied for this program called Venture Fellows at business school, got in. I was one of 11 students selected, was partnered with Lara Hippo for my full first year of business school, and for which I was a fellow,
Mhm.
and then actually became managing director of that program my second year. Worked with my team to change a lot of the curriculum and everything I thought the program could actually where it could actually be up leveled. We made it even better for second years underneath of me, but that was my plan, basically business school, and then worked my ass off, got internships, worked every single semester, worked with founders, worked with investors, and then landed my first role.
Yeah. I mean, it's amazing when you talk about business school because people who go there for a job down on Wall Street, they literally have their jobs almost handed to them. They're going to events almost every night the first semester. And if they get that internship, it's like they almost check out of business school.
Their
They're like,
second
why
year
bother?
at least, yeah, for
Yeah.
sure, yeah, yeah.
Yeah. But other people, like I was there, I was moving into the label side of fashion from being on the marketing side of it and very different kind of, I guess, rhythm. And I imagine venture would be similar because, as you said, the on-time hiring and nothing's
Totally.
guaranteed.
Yeah, I mean, it
Yeah,
was May going into graduation on May 12th. I didn't have any job offers yet,
yeah.
and that was really scary. Now, I was fortunate that by the second week of June, I had 3 job offers, and yeah, now I'm talking to students coming out of business school, and they were like, "Holy shit, you were so lucky because it's 6 months, 9 months after graduation, and I'm still interning or still looking." So I didn't realize how good I had it until retrospectively, June seems really nice. But it was definitely a hustle until the very end,
Yeah.
down to the wire.
Excellent. And you first experienced Remedy's model when one of your portfolio companies
Yeah,
worked with Remedy.
yeah,
Can you
yeah.
tell me a little bit about that?
Totally. I love this story. So yes, one of the first investments that I did out of the fund I joined right out of business school, it's called Swift Arc Ventures.
Hmm.
We had committed to a company called Ash Wellness. And little did I know, Ash was actually already working with Remedy Product Studio to do their build. And at the time, again, I didn't know the Remedy team, but Ash had also taken an investment from Remedy, and it was one of Remedy's first experimental investments. Remedy, just a little history, they've been around we're going on, I think, our 12th or 13th year, a long time. And for so long, Remedy was only and exclusively a fee-for-service agency. There was no investment function. And when Remedy invested in our portfolio company, that was their Remedy's first foray into this model. And the reason they did it is because in 2021, ClassPass was acquired by MindBody. Remedy had helped build ClassPass, and they didn't have any equity in ClassPass.
Wow.
So we were building technology that was core to the reason for the acquisition, which was the bookings engine, and we had no upside to show for it. And so that point forward, the partners and co-founders said, we should have skin in the game, right? So they started investing. One of their investments was our portfolio company. That was my first exposure to the model, and I was an evangelist from the start. My thought was, why aren't all of my portfolio companies working with a service provider that has a fiduciary responsibility to see them succeed?
Yeah.
I mean, can we talk about palm to face, no fucking brainer?
Yeah.
Sorry again for cursing. No brainer. Like, don't you want all of your portcos to have a vendor that has a fiduciary responsibility to the business, right? If they're short on payroll, we were just talking about this outside, and you can't pay. Like, there are contractual obligations we have to go after those startups. When we're invested, obviously we're not doing that. Like, we're going to be on your side, right? We're also going to be presenting optionality, not just taking orders like task monkeys. We're going to be suggesting better, faster ways to do things, or the 2-week experiment, so you don't waste a ton of money and burn and time to try to stand up whatever you're trying to build, right? So you have this actual partner, not just client-vendor relationship, when your service provider is also invested. Obviously, I loved this model. I don't know an investor who wouldn't like this. Our founders were extremely happy with Remedy, and so if work is getting done on time, under budget, and the founder's happy, obviously, I'm going to be referring Remedy to other founders in my network, whether or not they're my portfolio company, if those founders are looking for support with product and engineering needs, right? Just altruistically. There was no financial setup between myself and Remedy. I didn't even know the partners there. And I unintentionally sent Remedy so much business by being an evangelist for them that the partners did reach out to try to get to know me. And they were like, how can we work with you? What is your secret? And so I was like, it's really not my secret, it's yours, right? You're just doing something that I believe works, and I need all my founders to know about this. And so they effectively poached me to join the team, and I really stood up and formalized our investment function there. There was no formal CVC. In fact, if you've known Remedy for a while, you might remember a time when we used to do equity for service investments where we did the work in exchange for ownership. We've since evolved. I mean, it's evolved a lot since I joined. There was originally no formal diligence process either. Like, we've come a long way. But now, we operate truly like a CVC. We write cash checks. We invest just like any investor into the startups. And we also leverage our studio, the resources, product and engineering teams, to give these businesses an unfair advantage. And when you combine the two, the strategic capital with, I think, better than average outsourced talent, right? We like to call ourselves the anti-dev shop, the Remedy, the solution for everything that's really bad about outsourcing. And you really create this unfair advantage, in my opinion.
I mean, the fact that there's a fiduciary duty is just, like, that's amazing, because so many shops out there will be like, oh, we're partnering with you. But when push comes to shove, they're looking out for their own business, which they need to. And so you really are partnering with people and looking out for their business.
Yeah. And in fact, I think what's also interesting, and I've seen this now, because we invest selectively, just like any firm. We're not going to invest in every company that wants to work with us or needs support. But I've found that the businesses we didn't invest in, whether because they were too mature, too late stage for us, or didn't pass our litmus test for diligence, those lead investors are usually calling us to ask how the company's doing when they're deciding to take pro rata or not. Or at least calling me because they know that I am an investor. And that was another reason we started, in investing, because working with a company is going to be a much clearer lens into the performance of the business and the health of the team than any 2 to 3 week diligence process. You can't fake seeing inside of the company. I mean, we're literally in their Slack channels, right? Like, we interface directly with the team. And so there was a recent scenario where a good friend of mine from business school, now at a fund, I won't say which fund or which company, but called me because they were thinking about doing Series B pro rata into a company they invested a Series A. We did not invest in that business. The valuation was just too high by the time it got to our desks, but they did work with us out of the studio. And the lead investor is calling us to have a 45-minute call about the merits of the company.
Yeah.
So that really says something about this sort of inside peek that we have that most VC funds don't. And so when we have conviction, it's incredibly strong, one way or the other way, right?
Yeah. I mean, I feel like even when I'm talking to founders, and I'm telling them to be transparent because I can only help them so much because I need to know what's going on, there's just so much performance. There's so much pitching that's still happening
Yeah.
that it's really when you get into like behind the scenes
Yep.
that you actually see the mess.
Yeah.
And there's always mess. I mean, these are startups.
Correct. Yeah.
And so you need to see the mess to know how you can help.
Right.
But I feel like, there's such a culture of, no, everything's great.
Right.
Everything's wonderful. Nothing you're going to find here is a no.
Mm-hmm.
No red flags. So it really, I understand why people are calling you.
Thank you. Yeah, I
Yeah.
appreciate that.
That's amazing. So when you made the transition from traditional VC to Remedy,
Yeah.
what was the biggest kind of mental shift you had to make?
Yeah, it's a good point. So just for the listeners who might not be familiar with CVCs, since we invest off the balance sheet, we don't have LPs to return, proceeds to. And in a typical fund structure, you're usually splitting the distributions, if you will, any proceeds that come from an exit event, 80-20. 80 LPs keep, 20 you keep. So a few things to keep in mind is when you're investing off your balance sheet, I don't know if this is a proper term, I call it gravy on gravy investing. You're effectively taking a percentage of your profit margin, and it's play money, fun money that you hope to multiply, right? If the companies flop, your business, the holdco of the CVC, in theory, should already be profitable and healthy. Like, we're only investing profit margin. We're not playing with capital that is crucial to like our overhead costs or anything. And so the return profile that you expect and what good looks like is very different. That means it's interesting for us to also look at businesses that aren't necessarily your typical venture scale $100 billion sort of like exit potential. If there's a private equity firm that's rolling up physical assets, whether that's dental clinics or grooming, boarding, and daycare centers for pets, and they need some type of technology to help that company or those series of businesses operate faster, more efficiently, increase revenue, upsell, and they use Remedy, that's still really interesting. It's a shorter time horizon, lower multiples, but a little bit more guarantee on return. So like any VC fund, I'm still thinking about portfolio diversification. Of course, that's very important, but I don't need every single bet to return a fund. And we also don't have very specific equity targets or things that have to be true because we've already sold and pitched this idea to LPs that are now expecting a certain profile of investment. We kind of make our own rules. And, if I'm being honest, one of the reasons that I was extremely attracted to the CVC model is because actually the firm I joined after business school dissolved after year one. We can definitely go into that. It's a whole different tangent. But that was a combination of macroeconomic factors with Silicon Valley Bank going under, FTX collapsing, and honestly mistakes that the GP made where those macroeconomic factors took a toll on the firm. So things like not diversifying the LP strategy, too many high net worth individuals that are more prone to be spooked by macro, things like that. Doing first close too soon, a few others. I actually have a series of TikTok videos where I talk about this, but my point is I had a little bit of scar tissue from being at a firm and being at a firm that struggled really to fundraise and fell during economic collapse. Firms that, there's no real sense of seeing a career trajectory because financially it might not make sense until you have a big enough fund size for GPs to give up carry. A myriad of things that made the CVC model at a sustainable business that's been around for over a decade incredibly attractive. And one that's helping build because I've always enjoyed building and being an operator. And actually in between that dissolved fund and what remedy. I worked at a seed stage company for a while until they raised a Series A, and that was a company called Journey Clinical.
Yeah.
Yeah.
I mean, this is something we also talk about, is especially with emerging funds. Like, it is a startup.
Yeah, totally. Mhm.
There, unless you're at a huge fund, there aren't big salaries
No.
because there's not enough management fee
Right.
for big salaries. So, like, it's when I talk to even people that have big name funds at this point, they're on their second or third fund. I find out that they've had to do some interesting things, whether it's consulting on the side or getting a grant, or to actually, or working with an economic development council to, like, actually fund their salaries.
Yeah.
And I think a lot of founders are like, "Oh, VCs, they're set.
Right,
They're
VCs
set.
are
I
all
got
rich
all the money. They're
people.
all rich
Yeah,
people,
yeah, totally.
and they're just withholding the money from me." And it's like, no, these are actually people who are out there fundraising as well,
Correct.
and they have a fiduciary duty to their LPs, and, like, it's a whole different set of, I guess, it's a whole different set of things that you need to think about.
Yeah, and,
Yeah.
the hold period, especially if you're investing in traditional early stage venture-backed startups, the hold period is 7 to 10 years.
Yeah.
So it's a long game. You have quite a bit of time where, to your point, your salary is definitely gonna be below market if you're an MBA and that you could be making at a big bank or a big consulting firm or big tech, right?
Mhm.
Or insert big fill in the blank, right?
Yeah.
There are a lot of jobs out there that's gonna make you more money in the short term.
Mhm.
I think the VC archetype for a venture capitalist investor is one that really kind of not just believes, but walks the talk of high risk, high reward
Yeah.
because they're living it with their own lifestyles.
Yeah.
High risk, high reward.
Yeah.
You hold long, you're patient, and you really double down and invest in other people. And I think that was the biggest litmus test for people going to business school, actually, that successfully made it into venture. The students that were really shaky and not comfortable with the idea of not having a return offer after their first summer
Yeah.
quickly dropped from the venture curriculum. And I understand why. It's not guaranteed. You might be jobless for 2 to 20 months after business school, depending on, your ability to recruit and funds hiring capacity.
Yeah.
And if you really are a high risk, high reward person, you're probably going to fare well in the actual job of venture, and that pans out in the recruitment process.
Yeah.
Think about it that way.
And I mean, it goes back to, not everyone's meant to be a founder. Not everyone's meant to be a VC. Like,
Exactly.
you need to have a risk tolerance that is beyond logic.
Yeah. I say Delulu's the Solulu.
Yeah. I would agree with that. And,
Yeah.
and you have to get used to people saying, "Oh, are you still doing that thing?"
Right.
I mean, there are funds that I've interviewed that have, that have deployed capital, that this is the second or third fund for them, and they're still worried about having their second close.
Yeah.
It's just, yeah, it's a risk tolerance that only the people in this room and the people who are founders or VCs really get.
Well said.
Yeah, well, I don't know if it was well said, but I'll take it. So, what kind of founder opportunity really gets you excited?
I love this question. Okay, I talk about this a lot recently on my TikTok. This answer, I think, has changed a lot over the past 10 years for all investors. So I'm speaking on behalf of myself, but I've seen a massive shift about the archetype of which type of founder is going to be super successful.
Yeah.
I think in the past, it used to be the engineer archetype, or if you're a founder, you need some type of engineer, co-founder, CTO. Now, before people come at me in comments of this, of this podcast, it is still true that there are some foundational technology where if you're building for developers, or if you're building a biotech or life sciences company, first mover advantage really is your moat. Just building the thing is defensible because it is so hard to build and requires a lot of time, attention, energy, and approvals from government, etc. Taking that 1% of company aside, 99% of the businesses that are being built today are being built by people that I think are better suited with good industry experience, because it is now easier than ever to build a thing, right? There's AI, there's tools like Lovable and Figma Make and Replit and probably a handful of others that I'm forgetting to mention, that allow people without real sophisticated developer backgrounds to spin up an MVP. In my opinion, an MVP is really all you should be building to validate proof of concept and to understand if demand is truly there for what you're trying to sell.
Yeah.
And so the companies that get me excited are businesses that are able to prove that demand with extremely little upfront cost and time that's been put into this experimental business, right? And I think that companies that excel the most, at least historically, looking at our portfolio, past investments that I've made at other funds that have now kind of gone on with similar exit events, it's companies that had someone at the helm with innate and kind of unreplicable industry experience because of their years of work in the industry they're trying to sell and their ability to sell. I think founders, and I think this is unfortunately, founders that are more charismatic, that know how to sell, that can very clearly articulate the value proposition to the actual buyer are founders that are going to be successful.
Yeah.
And I think it's actually a shame to sometimes talk to founders that I could tell are probably brilliant beyond belief, almost like potentially like on the spectrum of so brilliant it's difficult for them to be social and communicate, or they can't really explain what they're trying to sell. And I'm on a pitch call with them, pulling out of them the facts and actually getting excited by what I'm extracting with these questions. But at the same time, then realizing that unless another investor is going to take the time that I am to pull out of you why this is so exciting, you're not going to be able to fundraise beyond me. And, you can't sustain a business with one person's check. And so if I don't believe that you can fundraise, even if I believe in what you're building, unfortunately, I cannot invest in you. And if it's difficult for me to understand what you're trying to sell, how can I expect the buyer to understand what you're trying to sell or be excited by what you're building?
Yeah.
And so that's actually, I hate those scenarios because I feel really bad. I feel bad because I know that these people are really smart and I know that what they're building is pretty fucking incredible. But I feel bad because I have very little confidence that they're going to be able to sell it. And if you can't sell what you're building, if you build it, they will come is a fallacy.
Yep.
That's not defensible. Something existing is not defensible, especially in an age where the risk for competition is larger than ever.
Yeah.
It's too easy to build. And so your first mover advantage used to be maybe 1 or 2 years because it took a while to build things. Now it's 1 or 2 weeks.
Yeah.
So if you're not good at selling, good luck.
Yeah, I feel like distribution and selling
it's everything.
Is everything right now. And one way that I saw a founder who is brilliant, but kind of hard to connect with, he has created such a solution that once he shows you the solution, it's like, oh, and he has sales and traction, right?
Yeah.
But it is hard. That charisma is not there. So you have to show more traction, I feel like.
Yeah. I mean, there's so many categories where there's different flavors of the same company. Ad tech is one of them right now. It's super hot in AI. Health is another one where, there's almost 100 different mental health businesses that exist. And I truly believe that inferior businesses can do better than the slightly better version of this product if they're able to sell it better, if they can unlock distribution and execution.
And I think if they can get on board users and get them addicted to their solution pretty quickly.
Right. So when founders say, well, I ask, sometimes directly I will ask about competition. So tell me about this competitor.
Yeah.
Why are you better than them? And they'll have this answer about technically why it's better. And what I really want to hear is because we're going to sell it better.
Yeah.
It's sad. Again, this is not, I think venture is a reflection of the way the world works, which is, unfortunately, we don't live in a meritocracy. We live in a relationship-based world. We live in a world where people get ahead because of their hustle, their ambition, and who they know. Sorry, that's the way the world works. That is just the way the world. I wish that wasn't the case, but it is true.
Yeah.
We all know it to be true. We all know someone in a job that doesn't deserve to be there, isn't as smart as you. They're there because they knew someone who put them in touch, et cetera, et cetera. And they met the baseline, right? They met the baseline skills, but you might be slightly better than that person.
Yeah.
But guess what? They're in the role and you're not.
Yeah.
Same thing about venture company building, right? You need to be in the right rooms. You need to be in the right press. You need to be talking to the right investors. You need to be building at the right time. You need to have the right marketing. Even if your product is slightly inferior, if you have all those things, you will do better than the other company. So at the earliest stages, I don't want to hear, well, this other business, our competitor, they don't have this, this, and this, and we're better because we have X, Y, and Z, not just X and Y. Well, are you selling better than them? Until you're selling better than them,
if no one knows about it,
call me when you're selling better than them, right? Exactly. If no one knows about it, then I don't know what to tell you.
Yeah. Something I'm finding as well is there are a lot of people in early stage who are doing a lot of hand-holding to onboard in order to get that, I get stickiness. Because again, it doesn't matter if you have 10 extra features. If no one's using it or no one knows how to use it.
Or no one knows about it. Yeah.
They're not gonna buy.
Right. Yeah.
So sometimes you start with a company as a service provider.
Yes.
And sometimes you invest.
Correct.
How do you make the decision of when a company's worth investing versus just service provider?
Yeah, it's a great question. There's a few things. Some businesses work with us and they come in first as just using our services because they're not actually fundraising at that time.
Yeah.
Because we're follow-on investors, we're minority investors, one thing we'll never do is arbitrarily set a valuation for you. That's one fundamental difference between what we do as a CVC and like an accelerator where every single company gets the same check size, gets the same terms, gets the same equity. We don't do that. And so if you're not actually raising right now, but you just raised and part of that use of funds was going toward product and engineering, and you come to us 6 months after your raise, you might tell me, Jess, reasonably, my valuation today is not what it was 6 months ago. And so while I'd love you guys to be on the cap table, I'm not willing to offer you the valuation from 6 months ago. I understand that. Unfortunately, though, I'm not going to set a new valuation for you. So let's work together. Let's get to know each other because it goes both ways, right? I want you to want to work with us for the long run and want us on your cap table. And we also want to get to know you better and then participate when you believe it's fair, founder, at a valuation you believe is fair or that the new lead is setting for the round. If the founder's telling us, look, I'm willing to do a safe note at the terms of my last raise, or this is what I believe to be fair now, here's like the price I want to set, then sure, we'll consider it. Again, there's really no rules at Remedy, but typically companies we're not investing in at first are businesses that simply aren't raising, or businesses that are way too late stage for our investment size, which is about $200K to make sense, right? To make sense for that round. So Series A, B, C. I get a lot of questions around the fact that because studio is in our name, Remedy Product Studio, that we must only work with businesses that are pre-product, pre-revenue, pre-seed. And that's not the case. We're not a venture studio. We're not incubating businesses or conceiving them from the ground up. 90% of our investments are at the true seed. So, and I'd say the 5% on either end are pre-seed, sometimes pre-product, pre-revenue, but with a very unique founder profile or some type of defensible technology that they want to build around. And then on the other barbell, Series A, companies that have a lot of traction, but maybe didn't get to know us early enough, and now we really want to get involved and there's meaningful work to be done and we believe we can meaningfully de-risk this business. So we're willing to do a Series A investment and get less equity because, again, we're not trying to return the fund. The equity is more about incentive alignment. But post $50 million valuation, that, a $200K check just doesn't really make a lot of sense. So those are two reasons why we would work with someone before investing. The other is simply they don't meet our standards. Just like any VC fund, we have a diligence process. It starts with an application on our website where we ask basic questions about, when you were founded, your current cap table, how much you're raising, et cetera. And then basically 3 open-ended questions, which is why this, why you, why now? And please send your data room if you have one, basically. And if we can reach conviction from those responses after digging in, then of course we're going to move forward with an investment.
What is your timeline usually for your process?
Assuming there is a lead already and there's terms that we're reviewing as part of diligence, we could come to a decision in 2 weeks, pretty quick.
Amazing.
Yeah. It's a really non-bureaucratic. It's myself running diligence. There's 3 other partners at Remedy, 1 leading engineering, 1 leading product, 1 kind of our overhead ops person, and 2 of them are the founders of Remedy Product Studio.
Yeah.
We have an investment committee meeting and it's vote by majority.
Yeah, that's amazing.
Yeah.
Because corporate VC can have a
Oh, yeah.
have a reputation of taking
a long
9 months.
time. Well, most corporate VC funds also have this remit. Well, corporate backing up, most corporate VCs are investing for some type of strategic purpose.
Yep.
And with companies like Amex Ventures or these health plans that have venture arms, they usually are investing in companies they themselves would be buyers of.
Mhm.
There needs to be some type of reason to believe in the solution to help the business in some way. So there is a lot of diligence that has to be done by those companies' procurement team first to see, would we actually use this product? And then it moves to the investment team once that's vetted to then due diligence. At Remedy, we are also strategic investors, but it's different because we don't have to be buyers of your solution. We're
Yeah.
strategic in the sense that we believe we can meaningfully de-risk the business through our support, just like, for example, Amex Ventures or NBA Ventures or Cigna Ventures believes they can meaningfully de-risk these companies because they're expecting to have large contracts with them.
Yeah.
So through an investment, if this were the public markets, it'd almost be insider trading because it's like, we, Amex Ventures, are going to invest in this company that we, Amex, are expecting to do a $5 million contract with next year. So obviously the revenue is going to go up and we can have a line of sight into a step up in our valuation because we are contributing to the bottom line revenue.
Mhm.
It's just a different way of looking at it. And by the way, that is legal because it's private markets, but like it would be absolutely not chill if that were the public markets. But that's how CVCs operate, and it's kind of genius.
Yeah, but it sounds like the negatives of CVCs don't exist with Remedy. Like fast decision.
Yes.
Another bad thing we hear about corporate VC is the amount of legal costs.
Yeah.
And you guys are investing usually on, you're not setting the terms, so
It's usually
you're
safe
covered.
notes.
Yeah,
I
it's
mean,
amazing.
we have done price rounds and notes and all the things, but it's most commonly safe notes. So it's
Yeah.
super easy.
Amazing. So can you tell me a little bit more about how, when you've worked with a company for a while, you've seen the inside, and how that's driven your decision to invest or not?
Yeah. Definitely. We've had experiences on both sides of the coin where we're working with a company and we get really bullish on them in a good way.
Yeah.
And we want to double down. And this was actually the catalyst for our syndicate, one of the catalysts. So we have this CVC function that's been around for a while. And recently we launched a separate vehicle, which is basically SPV creation through a syndicate. And we lean on this when we are really excited about a company and our max check size of 200K doesn't really cut it.
Yeah.
And we want to double down and we want to raise more than that. And we want to get external parties involved to make that possible. And so we'll bring in the syndicate. There's the other opposite side of the coin where, yeah, you work with the business and you see a lot of the scary things that go on. You see core team members leaving, quitting, getting really angry. You see people and churn happening. You see product timelines go awry because of external factors beyond the control of us at Remedy or the partner on it, quite frankly.
Yeah.
This happens a lot with integrations. When you're building a software where you're trying to create API integrations into other software, which by the way, this is very common with AI now. So AI CRM system integrate with your note taker and have the note taker drop in the notes, or building something for small businesses and you want to integrate with QuickBooks or healthcare, integrate with EMR systems for electronic medical records. There's a ton of integrations that happen with software. And oftentimes you can't just build an API into someone else's company if there isn't already open source capabilities to do that. In some cases, depending on the integration, you need to ask permission of that company to integrate.
Yeah.
That other company is well within reason to say, sorry, no, we don't want to open our code base to you.
Yeah.
And you're not going to just hack into some other company and build an integration. I mean, you're setting yourself up for some type of lawsuit later or some type of issue. So when you're planning on roadmap, things fall short, and we've seen revenue cycle through. We've seen contracts fall through, and so it happens. And when you're a partner with a startup for a long time, building alongside of them, in some cases we're on the brunt receiving end. We're also not. They're not paying invoices with us because contracts are falling through. Doesn't give you a lot of confidence to put your money in later.
Yeah. Wow. What mistakes do you see founders making repeatedly?
This is especially during diligence, I see founders, especially early stage founders. So I want to caveat early stage founders that have been around for less than a year. I see founders over index on showcasing these glorified forward-looking financial models that are painted with assumptions about a reality that's less than 6 months old. So they're not really viable assumptions. They're over discussing the future. We're the first of best in class, and we're going to have $100 million in revenue in 5 years. None of that matters. As I don't know if they think that those are things an investor wants to hear, but I'm an investor sitting at this table telling you I'd much rather hear about your current traction and LOIs and experiments you're running and interest from current partners and partnerships you're forging to create economies of scale or unlock distribution in some way. Those are things I want founders to double down on. And so to answer directly, the mistake that I see founders make a lot is talking over discussing the hypothetical future state and not putting enough time and energy on the current state, thinking that investors want to map to this $100 million revenue outcome. And of course we do, but we're not just going to take your word for it that that's possible. I want to see now that you're working toward that.
You have to build the bridge.
Yeah.
How do you think founders should think about valuation?
Yes. This is a really interesting question because valuation right now, I think, is across the map. I was in San Francisco in June for Tech Week and sitting across from a founder who basically just started a business 7 weeks earlier and was raising $3 million at a 30 post because they were coming out of Y Combinator. And like, kudos to that person, but I don't think that's a realistic valuation, especially for someone that has never worked in the industry that they're actually building for. I don't see the merit in that valuation. So founders need to strike a balance between not selling themselves short, not undervaluing their company, but also being realistic to try to get the round done. And so I'll tell you how investors set valuations. We look at comps. We look at both a combination of public market comparables in the industry that you're building in and seeing if this were to exit in a certain number of years, what would the public market multiple be? If you were to be acquired in a certain fewer number of years, what would the acquisition multiple be? Because I got to make sure that there's a step up in my valuation. So when you have a valuation that's too high now, you're setting everyone up for potential failure later if your future state merit can't back the fact that you can put a multiple on your revenue. Right? So if you're raising at $30 million post money now and you have only negligible, call it less than $5,000 in revenue, call it basically nothing, you need to be getting to a point where you can basically 5x your revenue and double or triple your previous valuation. I'm saying 5 is kind of a round number. I'm seeing multiples range from 2 to 3x to like 7 to 9x, depending on the industry you're building in. You really got to do that homework for yourself, but 5 is somewhere in the middle. And one thing you can do for yourself, founders, if you're wondering what a appropriate valuation is to ask the investors on the other side of the call. Say, hey, I'm just going out to raise. I really like this conversation. I really respect you as an investor. I'm curious, even though you're a follow-on investor, what do you think is a fair and reasonable valuation for a company in my industry doing about the traction that I'm doing? What have you seen? What is the range you've seen? I think founders often do themselves a disservice by not asking investors questions beyond what is your timeline? Like, what are you seeing? Would you believe is fair?
Right.
What would you invest in something like this? What are your hesitations? I'd be very curious. Open it up as a dialogue as you're getting advice. Don't kind of remove the fourth wall of this is a pitch call and frame it more as, I really respect you and I would love your feedback. When you frame it as feedback, you'd be surprised. Investors, I think, are much more likely to be actually honest and candid about their thoughts. And I'd like to believe, at least the investors I know, many of which have become friends of mine, they're not going to steer you wrong. They're not going to overshoot to get something for themselves. I think most investors are pretty honest. They'll say, look, I've seen a range. At least that's what I would say. I've seen between usually a founder with that type of revenue that I just described, negligible revenue, been around for a few weeks, seeing anything in this kind of bullish market right now between, call it like $7 to $15 million, depending post money, depending on the industry you're building in and the business model that you have, right? Kind of things that you could underwrite some assumptions to without using real traction. anything above like 15 million, like, are you Nobel Prize winner? Is this your third, second time doing this? What about you makes it more viable to be more than your average kind of post-money valuation. And in some cases, there are real things about the founder's background or some type of defensible technology, and yeah, sure, then I would go above that. But again, use the investors to gauge where you think you're at.
Yeah, but there's different frameworks. Like if you're a third time founder
Yeah,
with two exits,
yeah,
two good exits
right.
under your belt, like you can raise on
Yeah,
a huge valuation and you potentially can go out there and raise $13 million on an idea.
yeah, totally.
If you're a first time founder, that's most likely not going to happen.
Yeah. Yes, and just because you're a first-time founder and you see headlines of something happening, you need to read between the headlines, read the body copy, right? There's probably something else about that person or this business that makes it worthwhile.
Yeah. And I would say one of my toxic traits is when I see those headlines, it's literally, okay, what made this different?
Yeah.
It's like, it's not totally toxic, but sometimes it's like, is it just connections?
Yep.
Because that also, is very important. And you even said earlier that there's some people in jobs that are there just because they're connections. But I would say that those connections are actually part of their value set. Like
Absolutely.
it's part of their valuation, their own personal valuation.
Yeah.
And it can make us angry, those people that don't come from those circles. But we need to generate our own connections
Yep.
and relationships.
Exactly.
Yeah.
Yep.
But yeah, the valuation. So if you're talking to someone who just got out of YC, let's say,
Yep.
who has negligible revenue, is working on, let's say not trying, raising 3 million on a 30 million value, would you advise them to take down their valuation and take down the amount they're raising, or one or the other?
I try to never give founders direct advice in terms of like, do this, not that, because these are people's lives.
Yeah.
And so I don't ever want to be responsible for like a bad decision.
Yeah.
But I would tell them that if you're going to accept this high valuation, kudos to you for getting it, because that's a testament to you and Y Combinator.
Yeah.
You just better be really confident in yourself that, again, your revenue next year or in 18 months when you're going out to raise again
Yeah.
warrants at least a double or triple step up in that valuation, because right now your first valuation is not merit based on the fundamentals, if you will.
Yeah.
It's merit based on Y Combinator, it's merit based on you personally, perhaps, but it's not merit based on your company yet. So just be sure that next time you can reasonably believe you can get your business to that state. Otherwise, you're setting everyone on your cap table
Yeah.
up for failure. And really, your earliest fundraises, those valuations don't really matter. What matters the most is your valuation at exit. So I see a lot of times founders over marinating on or over fixating on this valuation on their first raise. It really doesn't matter that much. What matters the most is what you're going to raise when you exit and the multiple you're giving back to your investors and your employees, right? And so if you're thinking about that mindset, then like it kind of flips the script of, well, I kind of want my earliest valuation to be as modest and reasonable as possible, because I want to be able to say that we grew our valuation from X to Y, and you want that delta to be really impressive.
Yeah. And this used to be a little complex to model out, but I think that founders can easily do this and get some framework, some idea on what's rational
Yeah.
by talking to Claude or ChatGPT at this point, saying if I raise X amount at this valuation and then next round I raise X amount at this valuation and next, and we exit eventually with the end in mind, you can get a good idea if that's incredibly aggressive
Right.
and or not going to provide a good outcome for your early investors. I mean, we all know that there's so many things that play into every single round.
Yeah.
Things can change, but it can help you see if it's a rational idea.
Absolutely. Absolutely. And again, ask investors, ask people in your network.
So important.
Yep.
Yeah. How do traditional VCs react when they see Remedy on the cap table?
It's interesting. I'm still playing with that in the sense of some investors who really know me and get it, like are product minded and really astute financially.
Mhm.
They see the benefit in hybridizing your team. You're having some internal team members and some external team members that are going to be more cost effective and flexible, right? The ability to swap people, add and remove people as the needs arise. Whether or not you're using Remedy or another company, the ability to be flexible like that with employees is a real benefit to your bottom line. And so investors that know product and that are, like I said, really astute financially, really appreciate our model.
Mhm.
There are some investors that I think, and this is no offense to them, some of them come from more financy backgrounds or were founders with like marketing experience. They don't really get the benefit of hybridizing your technical team. And I think there is sometimes a misconception of we want everyone to be full-time,
Mhm.
in-house, internal, incentive aligned. And PS, that last point is part of the reason why we invest. We also believe in incentive alignment. That is key to having high bias for action and being solutions oriented and not just taking orders like a vendor. You need incentive alignment to feel like your decisions really impact the business.
Mhm.
So I agree with that point, which is part of the reason we have the investment function. But I think it does take some education to explain to investors like, look, there is real merit to having team members that don't require your management overhead, that don't require a career growth and development plan, that don't take 3 to 6 months to hire. Because, PS, the longer it takes you to build this functionality or feature that might unlock revenue for a different customer base or customer subset, that's time horizon on revenue. So the quicker you can get these people onboarded and the more flexible you can be in how that team comes on and off boards, it just makes so much sense from a financial perspective, from a time perspective, time to money, management overhead, overhead burden. I mean, healthcare benefits, payroll tax. I mean, there's a lot of reasons why it makes sense to outsource. The problem, and I think the hesitation for some investors and founders comes from bad past experiences with dev shops, which is
Yeah.
why we don't call ourselves a dev shop.
Yep.
If anything, we're like an anti-dev shop, dev shop. Product studio is we're always toying with actually like what should we call ourselves
Yeah.
because we don't want to be associated with dev shops because of how different our model is.
Mhm.
But we're also not venture studio.
Yep.
We're somewhere in between, and
You're
we
not
are
taking 30%.
yeah,
Nice. Yes.
we are product minded even when we're doing engineering work. So
Mhm.
we landed on this, but it is a constant education. Like I always have to explain what we do, and
Yeah.
that's okay with me because I love talking about it. But we are a very unique model in the ecosystem. So I don't expect everyone to hear product studio know exactly what I mean when I say it,
Mhm.
but it definitely requires some discussion.
Yeah. And what do you feel, like, how are founders open to alternative models like this?
I think they are when it makes sense. And what I mean by that is if founders are authentically raising
Mhm.
with the intention of growing their product and engineering team, it makes a lot of sense. And they're most of the time always open to at least a phone call,
Mhm.
at least a phone call to understand more about how does it actually work? Where are your team members based? Like, what is the investment like? Oh, it's not equity for service. Oh, that's interesting. Like they are open to learning more most of the time, especially if that's an authentic part of their use of funds.
Mhm.
It doesn't work for everyone. This is not a fit if you're a CPG business that wants to use most of your fundraise on inventory and marketing.
Mhm.
Can't help you there. I'm not pretending to, right? That's not going to be a fit for us or
Right.
you. But I do find that most founders are open to this, and I think that again, similar to the VCs that are most open to this model, founders that have a really good financial team or a financially minded CEO or co-founder are always definitely ears perking because our model aims to be cost effective like a dev shop overseas. Many of Remedy employees or team members are based in Latin America and Eastern Europe.
Mhm.
They're full time with us and we recruit and train them with the intention of keeping them on in perpetuity with industry expertise, just like the analogy you made earlier, like the McKinsey or the consulting firm of technology. But we are trying to be cost competitive with other outsourcing models. Add to that the ability to invest to align incentives, and we are both cost effective, flexible, and incentives aligned. We're kind of the best of both worlds.
Mhm. Absolutely. What's your take on the current fundraising environment?
It's a scary place. I think it's so polarizing. I'm seeing either founders, again, with very little merit or strong fundamentals raise at pretty crazy valuations because of the type of company they're building or the business model or the AI of it all.
Yeah.
And in some cases, again, if you're building something totally foundational, you're not putting a ChatGPT or Anthropic wrapper around, what you're building, then, sometimes those valuations make sense. But we're seeing really, really crazy valuations, very high growth businesses in short, compressed timelines, and then formidable companies created by veteran industry executives that know the market they're selling into with pretty steady and consistent growth that just isn't as fast or exponential,
Yeah.
really struggling to fundraise with a much more proven business model, albeit slightly slower. And so at least at Remedy, we are way more likely to invest in the latter, these formidable founders with industry experience, because we believe we can de-risk the technology and add velocity to that team. And again, we don't necessarily need to return a fund with a exit outcome that's an IPO. We are more than happy getting you to a point of an exit by acquisition and 3 to 4xing the valuation and walking away really happy, turning our profit margin into a 4x multiple. At a traditional VC fund, I completely understand why that's really not an outcome you're vying for, because you need to think about your whole portfolio, what you promise to investors, making back your management fee. There's so much at play.
Yeah.
And so it's polarizing. It's founders really struggling, really, really struggling with formidable businesses, and founders without formidable businesses raising pretty crazy valuation.
Yeah.
I'm not really seeing the in-between. It's that's what I mean by it's a little scary.
Yeah. I found, because I have a client who raised Midwestern company,
Yeah.
like consistent growth, huge clients. We had a scout that I've known for years approach us, a Silicon Valley scout, got to the final meeting. They ended up not investing. Like, he flew out to San Francisco, coffee shop, whole thing, did not invest. Ended up finding investors in the Midwest because they understood the core values there. But yeah, it's like, you're like, how can you not invest in this company? It's so clear that it's growing and but it's just not the right fit for certain investors.
To your point, actually, our last two investments were from Kansas City and Chicago.
Yeah.
And actually, the company we invested in from Kansas City, HQ'd in Kansas City, is probably the strongest business I think we invested in all year.
Yeah.
And that deal came to me from a friend of mine who works at a fund in Dallas, Texas.
Huh.
Proving your point.
Yeah.
P.S. I met this investor through my TikTok videos. So really cool, like the way the world works. But yeah, really reasonable valuation, incredible traction.
Yeah.
Formidable business selling into the restaurant space. And, founders come from Toast, founders come from operationalizing other franchises. Just the team is so strong. The fundamentals made so much sense. And they were, before we came onto the cap table, I knew that they were struggling and it all to fundraise. And it all culminated in the end with like a really nice raise. And I'm so proud and happy for them.
Yeah.
But it took them quite a bit of time. And then you see, on the flip, the San Francisco Y Combinator 23-year-old founder, no industry experience, raised in 4 weeks. Yeah. Okay. Make it make sense. And kudos to that archetype of founder, but like make it make sense.
It will make sense in a couple years.
Yes.
Like, we'll see the fallout or the successes.
Yep. You're right.
We're just in a very particular time, I think. Looking ahead, how do you think Remedy's model is going to evolve?
We are always evolving, and I really appreciate this question. And it's one of the reasons why I love working at Remedy. As I mentioned, they started as just fee-for-service agency, no investment. Moved to this equity-for-service model. Made it even more easy and straightforward for founders to get funding, and now we operate like a CVC. Most recently, we added the syndicate. We are, as you can see, constantly evolving to meet the needs of our partner companies and of startups and the ecosystem.
Yeah.
Where I would love to see us evolve in 2026 is to be more friendly with private equity firms because of the nature of how we invest and because of what we do well, which is taking legacy businesses and non-tech forward industries and operationalizing them through technology. And so if you're a private equity fund or an investor and you hear this and you're watching this, like, give me a ring, because that's an area where I want to do more of.
Yeah. Can you talk a little bit about the syndicate? Like, who when you have a deal that you
Yeah.
want to have the syndicate invest in or create a syndicate, how do you handle that? Who's doing the outreach?
You mean to the investors, the
Yes.
LPs?
Yes.
It's mostly me and one of my partners, Iggy, who actually raised a few syndicates on his own in the past. So a few of us at Remedy, aside from myself, like we're angel investors prior, and
Yeah.
so that was why they were comfortable with the idea of standing up the investment function at Remedy just to start. We're a crop of former founders, angel investors, and VCs ourselves. So, I mean, I think that's part of the reason why our model works and is constantly evolving because we get it.
Yeah.
But how it works is, the way the companies come into our pipeline is either through direct deal flow or our studio that's working with them fee for service. And we will reach out to our network of friends, current operators that we're actually working with. One of our largest checks actually came from a business we're helping build, the founder of a different company, which is a huge testament to our network, and other LPs. And it's pretty straightforward email distro. We're actually thinking about moving on to a platform called Play Money, and maybe playing with how we actually formalize that a little bit more. But it's usually myself and my partner Iggy that's doing all the outreach, marketing the deal, getting interest, and then doing the wire and allocations.
Very cool.
Yeah.
I appreciate you telling me. I'm just syndicate curious.
Yeah,
So
yeah,
I
yeah.
appreciate it.
It's a lot of just hustle, like
Yeah.
really creating a list, spreadsheet,
Yeah.
email, create drip campaigns. We use a CRM system called Atio. It's it's nothing. I mean, we like it, but it's nothing special. You can do this with HubSpot or any other Salesforce. And we now have a list for our syndicate investors, and you can create drip campaigns through Atio. That's how we did our first one. And we realized we want to just streamline that a bit further. So we're looking into platforms like Play Money, for example.
Very cool. Any hot takes on I know you're really good at hot takes. So any hot takes on the current venture capital or startup ecosystem?
I think, yeah, I think the whole ecosystem is kind of in for another rude awakening, similar to 2023 when
Ouch.
I hope there's
No, please.
I hope there's no more bank collapses and bank runs or, crypto fraud going under with the Sam Bankman-Fried situation. But one thing that I've noticed is similar to what happened with FTX, where there was one bad actor at the helm of a very prominent company. We're seeing a few other potentially bad actors at these venture darling businesses like OpenAI,
Yeah.
where there was that whole indictment that happened recently with Ilya Sutskever at OpenAI trying to out the current CEO, Sam Altman. And there's a lot of money going into OpenAI, both from a ton of startups that leverage the tool and platform as wrappers around their own functionality. There's wild valuations. There's founders raising without merit. And I mean, I hope none of this is the case, but we are objectively seeing the recipes for a bubble bursting.
Yeah.
The ingredients are there.
Yeah.
I hope the environment around the bubble can sustain it so it doesn't pop, but it's pretty undeniable that the ingredients are there. And I think the recency bias is a little bit too palpable because 2023 was not that long ago. It's not like you're talking about the .com era, which is not crazy long ago, but the recency bias is less there. And I think, again, coming from a fund that dissolved because of a lot of these macroeconomic factors, it's to me more visceral than ever. And so I don't even know if this is a hot take, but I am kind of bracing myself for 2026 corrections. And I do think it's going to be a really positive thing, though, for the venture ecosystem because we'll start to see the winners emerge. These crowded categories, same company, different font, negligibly different traction. They're all kind of raising around the same time.
Yeah.
We're going to start seeing some breakaway horses. And I think that's going to be a good thing for venture and simultaneously sort of a bad thing for, the ecosystem writ large.
Yeah. It's just so funny because I remember May of 2022, the first market correction, and then you just kept watching. When is this going to start coming back up? And then at some point after Silicon Valley, you're like, oh my gosh. And then finally things started to pick up a little bit.
Yeah.
And you didn't notice it. You just stopped noticing the negative things.
You're so right. Yeah, it was really, um, low volume, if you will.
Yeah,
Like, it was a
incredibly low
yeah,
volume.
yeah.
No one was writing deals like in Q2, Q3 of 2022. It was
Yep,
rough.
yep.
Um, I don't I don't love hearing that we think there's gonna be a correction, but I also understand the reasons behind it,
Yeah,
potentially.
yeah.
Yeah. What's the biggest lesson you've learned the hard way?
I have learned so I'm you have to understand a little bit about me. I'm the type of person that always assumes the best in people.
Mhm.
Always, and I always have been. I always, if someone's being rude to me, I always think, that maybe they're having a really bad day. Or maybe something's going on in their life. Like I'm a type of person to roll the punches off my shoulder. It's not personal. I never take anything personally, which I think is a good thing. But it's bitten me in the ass before,
Yeah.
being a venture capitalist. We once had a founder, that was working with us actually through the studio, and we realized there's a fuzz here in front of me. There we had a we had a founder working with us out of the studio and realized that they were actually cooking their books.
Oh, jeez.
And we brought it to light because they had a hard time paying our invoices.
Mhm.
And we had also made an investment in them. And so, of course, when something like that happens, we're not going to go to our contractual obligations to get the payment and sue them. We're going to be patient. We're going to say, hey, your best interest is our best interest. We don't want you to rack up legal fees. Your bottom line matters to us.
Mhm.
What type of payment plan can we put you on? What are you comfortable with? Like, help us help you. We were really, really sweet about the whole thing, in my opinion. And they started not communicating, ghosting us, didn't hear from them. And finally, I reached out to the lead investor on the cap table and I called them up and I said, hey, are you aware of what's going on with insert portfolio company? We're really worried about them. We haven't heard from them. We knew they were having a hard time making payments. We continued to build despite them being behind on multiple invoices, which we usually don't do when we're not invested because it's not really in our best interest to
Yeah.
do so. And the lead investor said, what do you mean? They're doing great. They were just in our office. We just saw their financials. From our perspective, they're one of our strongest portfolio companies right now. Like, we're very happy. And I said, well, that's interesting. They're either misrepresenting the truth to us
Mhm.
because they haven't paid invoices and they keep telling us they let go of people and they're financially really strapped, or they're misrepresenting the truth to you because both things can't be true at the same time. And that investor looked into it and realized they were misrepresenting the truth to them.
Yeah.
They were cooking the books. A lot of their traction was false.
Ugh.
They were, in fact, not able to pay their invoices. There was, in fact, no money in the bank. And it was a real sad reality. What did you learn the hard way was the question. I've learned the hard way. If something feels weird in your gut or feels funny, investigate it. Speak up.
Mhm.
Speak up. And I wish that I had called the lead investor sooner
Yeah.
because the lead investor was thinking about putting more money in and helping them and bailing them out. Really, what was happening was the founder was effectively embezzling that cash. And so we had a conference call to understand, should we proceed with legal action against this company? Because that's fraud. It's financial fraud to be untrue in your financial statements or
Yeah.
misrepresent your financials. And what we realized was if the money has been spent and we saw the bank account, it had been spent, then even if we win a judgment and we are in favor of the truth, it doesn't mean we're going to get our money back, and we're just going to waste a lot of legal costs on our side
Mhm.
and put this person away who is a single parent.
Yeah.
And we didn't want to do that, and we didn't want to spend more of our money
Mhm.
when we were already out 5 months of invoices, and the other investor also didn't want to spend more of their LP money, management fee money,
Yeah.
just to not actually get the money back that was already spent.
Yeah.
So it kind of just got brushed under the rug, which was a really shitty experience to be in.
It's super rough.
Yeah. Yeah.
I've had this conversation with my co-founder. Like, there's times when you just need to evaluate what the outcome would be and whether it's worth it,
Yes.
even when people are acting fraudulently or not in integrity.
Yeah. It's
So-
funny. I feel like I see one headline at least a quarter,
Mhm.
definitely a year, of some similar scenario to this with founders, some of them very prominent. I mean, we could probably all think of a few headlines. Raise a lot of money on a lot of hype, a lot of traction that wasn't really real or fudged a little bit. And again, that's something I learned the hard way, which is in the diligence process, you're asking for documents that are created.
Mhm.
You're very rarely given access to someone's bank statement
Yeah.
or their history unless you're running a background check on them, which I actually find more and more funds are starting to do but never did previously.
Mhm.
In all my years working at multiple funds during business school and after, I've never run a formal legal background check on someone. Now I know a few funds that are doing that, and with good measure, they should.
Yeah.
If we had run a background check on the founder that I was just telling you about, we would have seen some sus things.
Mhm.
And maybe we would have thought twice about giving them money. But, you see a financial model. What is a financial model beside an Excel spreadsheet that someone made?
Yep.
You could rip that off the internet if you want to. And what is traction beyond what you create in a pipeline document? Did you call the buyer yourself and ask to speak with the buyer? Now more and more funds are doing that. I'm definitely doing a lot more reference checks across the board since that scenario came up. I'm doing a lot more founder reference checks that are unassisted, meaning I'm not asking the founder for people they want me to speak with. I'm doing the own LinkedIn scouring myself. I'm doing a lot of customer reference checks by myself, unassisted, because again, you can plant whatever person you want to write you in the best light as possible. So I think it's even more homework that has to be done. And it's unfortunate because, again, I want to assume the best in people. I want to assume the documents you provide me are true and accurate.
Yeah.
But I've learned the hard way that's not always the case.
Yeah.
Yeah.
When you're evaluating a company, are you looking for, and this is giving you a tell into what I'm looking at, are you looking for what's wrong? Ever? Are you looking for a reason to say no in your due diligence? Or are you looking when for for context, I
Yeah.
should say, as I just stuttered, uh, we're working with a lot of founders, and literally I find myself, as I said before, like trying to find where the holes are.
Yes.
And that's more in service of us helping them
Yep.
to create a story or to fix those problems. But I imagine as an investor, you need to do more of that.
Yeah. I think most investors are probably running diligence with the intention of poking holes because the first few calls are very exciting. Like
Yeah.
if you're moving into diligence, it's
Mhm.
probably because you like the founder, you like the category, you appreciate what they're building, and you're excited by them. And so the diligence process is basically an exercise to prove yourself wrong.
Right.
It's to poke holes in
Mm.
your own argument to make sure you're making a sound decision.
Mhm.
So I'm going into diligence wanting to be right, but poking all the holes
Yeah.
I can to make sure that I'm making the best decision for my firm and myself as a recipient of the proceeds from the firm. And I think any investor who says they're looking to get to a yes probably isn't actually running a really good diligence process, right? I mean, think about how you would pick a spouse, right?
Yeah.
Like, I think the most successful marriages and relationships are ones that are not ignoring red flags, right? Someone treats you bad or does something inappropriate, and oh, well, they're hot, right? No, you're going to be like, well, that was inappropriate and made me uncomfortable, right? So I think in most scenarios, with anything in life, you go in wanting to have a good outcome,
Yeah.
but you'd be doing yourself a disservice, whether that's for an investment or a partner or an expensive purchase you want to make by not doing your homework. And so, at least personally, when I'm doing my homework, if I ever work with a listener of this podcast in the future, I am always poking holes.
Yeah.
Yeah, I want to be right, but I'm looking for ways to be wrong.
Yeah.
I'm testing every assumption.
And you can even find the holes and still decide it's someone you might want to invest in. Like,
Totally.
but knowing that the holes are reparable, like that are fixable.
Absolutely. You're never
Yeah.
going to find an early stage business without risks.
Yeah.
By nature, investing early stage is risky. If you find a business with absolutely no risks, you are missing something.
Yeah.
Pump the brakes. There's definitely risks somewhere, right? Even if they're external, even if they're, well, this company is incredible, founders amazing, they're building something awesome. But it's based on a regulatory framework that might change,
Yes.
right? Or some type of external factor that might be beyond the company's control. There's always going to be a risk involved. And so it is your job as an investor to find the risks and outline the possible mitigations. And if you believe that the pros outweigh the cons or the potential rewards and merits outweigh the risks, then you proceed. But you're never going to be in a situation where you find a company without any risks.
Right. Yeah.
Yeah.
If you did.
Unless
I
you're
wouldn't believe
investing
it.
in a business,
Yeah.
you have some inside knowledge about a company that's about to IPO and you make the investment a week before. I mean, which isn't really the nature of early stage investing.
Yeah.
So,
We've talked about all the work you do, and you also have a very strong following on social media. How do you stay mentally, physically, emotionally healthy? Be
I
extraordinarily busy.
I just got my Aura ring like this week.
Nice.
Which has been very enlightening. And
Is it gold? Is that?
it's gold.
It's
Yeah.
beautiful,
Thank you.
but-
Yeah, I got the gold one. I didn't realize till after the fact the gold one's actually more expensive. So, well, I like gold, as you
Yeah,
can
me too.
tell. So, whatever. But it's been really enlightening. I have been listening to it more. It tells me when to wind down. It tells me when I've been sitting for too long. Like,
Yeah.
you're working too hard. Take a walk, right? Like, take a break. I used to be very against wearables because I do believe, especially for young women, but anyone of any gender, it could be unhealthy to be so attached to metrics. And if you feel good and you think you look good, then live your life. I never think you should own a scale or like be so maniacal about your data. So I was always against wearables. And more recently, I've been noticing that, like, I don't think I'm sleeping as well. I don't know if my choices are really serving me. And so I noticed that people with an Aura ring, they generally are just more conscious about their decisions. I was recently at a holiday happy hour, and I was in a circle with 3 people that weren't drinking. I was the 4th person. And I was not like I was drinking heavily. I had a glass of wine, 1 glass of wine at a holiday party.
Yeah.
But all 3 of those other people are Aura ring wearers. And like, my Aura ring tells me when I drink, even if it's a glass of wine, like my sleep isn't as good. So is it really worth it? Like,
Yeah.
you're not really getting tipsy or anything. It's extra calories. Like, I have nothing against a glass of wine, but it's not really serving me.
Yeah.
And so when you reframe those things, I don't know, I think it's powerful. And so one thing that I have been doing in addition to the Aura ring is I'm a huge reader. I read basically a book a month, and I don't read.
Hard copy?
No, I'm a Kindle girl.
Okay.
Kindle through and through.
Yeah.
Part of the reason I love a Kindle is because you don't have the intimidation factor of a brick, which is usually when I read. I read like, thick books. And I read a lot more not knowing how many pages they are. And they're
Yeah.
comfortable. I
Yeah.
can carry it with me. I can use it at night with the backlight. Kindle made me a big reader, but I love fantasy novels because it just allows me to escape a little bit before bed.
Yeah.
Whereas prior to me being a reader, so I got very into reading over the past few years, I was always one to just constantly marinate on my to-do list at night or think about other things. And what Aura Ring calls latency, the time where you get in bed until the time you fall asleep, my latency without knowing from the Aura Ring was definitely like an hour or 2. I'd be just laying in bed up at night thinking.
Yeah.
With reading, you really just escape into another world. And I literally read fantasy, so I'm actually doing that. And it is the only thing that works for me to completely calm my mind and then just revisit, my favorite characters for a little while.
I love that.
Yeah.
That's fantastic.
Thank you.
Cool. I really appreciate you coming in today. I know we've covered a lot.
Thank
Do you
you.
have any last words that you want to say to the audience?
I loved this podcast. Thank you so much for having me. The last thing I would say is to double down on a piece of advice I shared earlier, which is use investors to your advantage. I know that pitch meetings can feel intimidating and rushed. You all often don't have a lot of time, but save some time for yourself to ask questions and get feedback on benchmarks, valuations they're seeing. What does good look like? What are your thoughts about what I just shared with you? What is your propensity to move forward? I very, very rarely get asked these questions from founders, and I'm more than happy to share. Just time doesn't always allow, or they're not asking me. So I'm not always volunteering that if I have a minute left on the call. So do yourself a favor, end the conversation early, manage that flow, and get some questions answered and use these people to your advantage.
Good questions.
Good questions.
Yes, I love that. Again, I really appreciate you coming on. The intent of this whole podcast series is to help founders understand, both sides of the marketplace, both sides of what investing looks like, so that they can do a better job of creating startups that can create value in the world.
Yeah.
So thank you so
Of
much.
course. Thanks for having me.
Absolutely. And I'm Helena Fogarty, and this was Inside the Fund.